The most dangerous bank fee in retirement is not always the fee you can see. It is the fee that appears after your balance looked safe, after your debit card was approved, after your Social Security deposit arrived, and after you believed the transaction was finished. A checking account can show $240 in one moment and still produce two or three separate charges before the next morning. Not because someone stole your money, but because the bank's available balance, the bank's ledger balance, pending authorizations, automatic payments, and posting order are not the same thing. A $6 pharmacy purchase can become a $35 overdraft charge at one institution. A second small payment can create another charge. A recurring insurance draft can arrive hours later and create a third. What looked like a harmless mistake can turn into more than $100 disappearing from an account that may only receive one retirement deposit each month. Pay close attention to this. Many retirees believe a bank cannot charge an overdraft fee if the mobile app showed enough money when the purchase was made. That belief is dangerous. The balance displayed on a screen may include a deposit that is not fully available, may fail to reflect a merchant authorization that has not posted, or may change when a gas station, hotel, rental car company, pharmacy, or restaurant adjusts the final amount. The number you see is not always the number the bank will use when every transaction settles. Most people never realize this until the account is already negative, and the problem is bigger than overdraft. A bank account advertised as free may still charge for out-of-network ATM use. Paper statements, cashier's checks, stop payment requests, incoming or outgoing wires, returned deposits, dormant accounts, replacement cards, account research, expedited delivery, early account closure, safe deposit services, or transfers from another account. Some institutions waive monthly maintenance charges only if you maintain a minimum daily balance, receive a qualifying direct deposit, make a certain number of transactions, or keep another account open. Miss the condition by 1 day or $1, and the fee can return quietly. This is happening quietly across ordinary households. A retired teacher in Ohio sees a $12 monthly service charge and thinks it is too small to fight. A veteran in Arizona pays a $3 ATM fee to the machine owner and another $3 fee to his own bank, then repeats that 4 times in a month. A widow in Florida keeps a small savings account untouched for emergencies and discovers a dormant account fee months later. A couple in Pennsylvania keeps $2,000 in checking to avoid a maintenance fee while the bank pays almost nothing on that money, even though a different account could have produced interest. Each amount seems minor by itself. The system depends on people treating each amount as too small to investigate. But small bank fees become large retirement losses because retirees do not have unlimited time to replace the money. A 30-year-old worker may earn another paycheck next week and another raise next year. A 72-year-old living on Social Security and withdrawals from an IRA may have one fixed deposit, one required distribution, one Medicare premium, and one narrow margin for error. A $35 charge is not just $35. It can cause the next payment to fail. That failed payment can create a merchant fee. The negative balance can remain long enough to trigger an additional charge. The bank may restrict the account. A missed credit card payment may create a late fee and interest. The account holder may then use more credit, and the cost spreads. Here's what almost nobody understands. Banks are not looking at your life the way you look at it. You see a pension check, a prescription, a utility bill, and groceries. The bank's systems see transaction codes, timestamps, authorization holds, merchant categories, recurring debits, incoming ACH credits, risk signals, account age, balance history, device information, and patterns compared with prior activity. That does not mean every customer is under investigation. It means the system is automated, and automated systems do not know that you spent 40 years working, that your spouse recently died, or that your daughter is helping you move money between accounts. The system responds to patterns, not personal history. The Federal Reserve influences the cost of money through interest rate policy, but the Federal Reserve does not decide the fee schedule printed in your checking account agreement. The IRS receives information reported on forms such as Form 1099-INT and Form 1099-R, but the IRS does not review your daily checking balance before a bank charges a maintenance fee. Social Security sends benefits according to its payment system, but Social Security does not guarantee that your bank will waive an overdraft fee caused by a payment arriving after another debit. Medicare may deduct premiums from benefits or bill some people directly, But Medicare does not monitor whether your account has enough available funds on the day a payment is attempted. These systems touch the same household, but they do not protect one another automatically. This is not automatic. That sentence matters more than most people understand. A fee waiver is often not automatic. A refund is not automatic. An overdraft opt-out is not automatic in every category of transaction. A dispute is not automatic. A lower-cost account is not automatic. A checking account report correction is not automatic. An appeal of an income-related Medicare premium is not automatic. A penalty waiver for a retirement mistake is not automatic. You have to identify the issue, ask the right question, use the right deadline, and sometimes submit the right form. Banking regulations create minimum protections and disclosure duties, but they do not force every institution to offer the same account, waive the same fee, use the same cutoff time, or provide the same courtesy. Regulation is a floor, not a personal financial plan. Your protection still depends on the product you chose and the actions you take. The first warning sign is a bank statement that you no longer read line by line. Many people stopped reading statements when banking moved to phones. They check the large balance at the top of the screen, glance at the last few purchases, and close the app. But the large balance is not a fee audit. The statement is where monthly charges, ATM fees, overdraft fees, returned item charges, interest paid, automatic transfers, and account disclosures become visible in one place. When the statement is electronic, the bank may send only a notice that it is ready. If you never open it, you may miss both the charge and the deadline to challenge an unauthorized transfer. Federal rules provide important protections for electronic fund transfers, but the protections depend heavily on timing. If an unauthorized withdrawal appears on a statement and you did not lose the physical card or PIN, notifying the institution quickly is essential. Waiting beyond the applicable period can increase your exposure to later losses. When a debit card or access device is lost or stolen, reporting within 2 business days can also make an enormous difference. Most people think the bank will simply recognize fraud and put the money back. Sometimes the bank does. Sometimes the bank investigates. But nobody is going to tell you about every deadline while the clock is running. You must act. Now watch how this works in a normal retirement household. Robert is 68. His Social Security deposit is $2,180. His mortgage is gone, but he pays property tax through a monthly savings transfer, a Medicare supplement premium, utilities, auto insurance, and 2 credit cards. On the 3rd day of the month, the app shows $1,160. He buys groceries for $92 and gasoline for $40. The gas station places a temporary authorization that is larger than the final purchase. A medical bill that Robert forgot was on automatic payment arrives. A check he wrote to a local contractor also clears. The bank's available balance changes before all final amounts settle. Robert wakes up to 2 fees. Robert calls and says, "But I had the money." The representative says the account did not have sufficient available funds at the time the items posted. Robert hears those words as an accusation. They are not necessarily an accusation. They are the language of the account system. He can become angry and hang up, or he can ask better questions. What was the available balance immediately before each item? What deposit was on hold? What authorization was pending? What was the exact posting sequence? Was this an authorized positive, settled negative transaction, sometimes called APSN, where the balance appeared sufficient when the debit was authorized but was negative when it settled? What does the deposit agreement say? Was there an alert available? Can the fee be reversed as a courtesy? Can overdraft coverage be changed? Is a linked savings transfer cheaper? Is there a no overdraft account? Most people never ask those questions because they believe the answer is already decided. It often is not. You have to claim it. A bank may have a written fee schedule, but it may also have a courtesy refund policy, an account conversion option, a hardship process, or a different product that removes the fee entirely. This helps both lower-income retirees and comfortable middle-class retirees. A person living on $1,500 a month needs every dollar. A couple with $400,000 in retirement savings still should not lose hundreds of dollars a year because they never examined the mechanics of one checking account. The most important fact at this stage is that the fee is rarely the first event. The fee is the final visible event in a chain that began earlier. It may begin with a direct deposit condition that was not met. It may begin with a merchant hold. It may begin with a transfer that arrived after a cutoff time. It may begin with a check that was forgotten. It may begin with a subscription that increased from $9.99 to $14.99. It may begin with a bank changing the account's terms after sending a notice that looked like ordinary mail. The charge is the smoke. The mechanism is the fire. And before I explain the most expensive version of this problem, you need to understand the difference between opting out of one type of overdraft and eliminating every possible overdraft charge. Federal Regulation E generally requires affirmative consent before a financial institution charges an overdraft fee for ATM withdrawals and one-time debit card transactions covered by the rule. But checks and certain recurring electronic payments can be treated differently. A person may say, "I opted out," and still face a returned payment fee, a merchant fee, or another consequence when a check or recurring debit arrives without enough money. The words overdraft protection, overdraft coverage, and linked account transfer may sound similar, but they can describe different services with different prices. That is the first major revelation. The choice is not simply overdraft or no overdraft. The real choice is which transactions will be paid, which will be declined, which may be returned, which fees may apply, what backup account will be used, and what happens to the next payment in line. Once you see the account as a sequence instead of a balance, the warning becomes obvious. A safe-looking number can be misleading because money is moving through several clocks at once. The second warning is the account that calls itself free while quietly requiring your behavior to remain perfectly predictable. The word free usually means no monthly maintenance charge under stated conditions. It does not mean every service is free, every mistake is forgiven, or every condition stays the same forever. A bank can offer a checking account with a $15 monthly charge and waive it when a customer receives at least one qualifying direct deposit, keeps a stated minimum balance, or meets another condition. The customer remembers only the word free. The system remembers the condition. Imagine Linda, a 66-year-old former office manager in North Carolina. Her employer used to deposit her paycheck twice a month, so her fee was always waived. When she retired, her income changed to Social Security, a small pension, and occasional transfers from savings. One month, the pension administrator changed the description or method of a payment. Another month, Linda moved money manually instead of receiving the type of electronic deposit the account required. The bank charged $15. She assumed it was a mistake and ignored it. The next month, it happened again. By the time she called, she had paid $60. The representative explained that the deposits did not meet the waiver language. Linda felt cheated because money entered the account. But money entered the account and qualifying direct deposit are not always identical under an account agreement. This is the mechanism invisible to most customers. The marketing message is simple. The operational definition is precise. The computer does not ask whether Linda retired. It checks whether the transaction code met the condition. The correct response is not panic. It is to request the current fee schedule and the exact account requirements, then compare them with the last three statements. Ask the bank to identify every month in which a waiver failed and the specific reason. Ask whether Social Security, pension, annuity, or other ACH credits qualify. Ask whether there is a senior account, basic account, no overdraft account, or account with no maintenance requirement. Ask whether relationship balances in savings, certificates of deposit, brokerage, or retirement accounts count. Then ask for the past charges to be reviewed. Most people think they don't qualify for a refund because the fee was technically permitted. That is not always the end of the conversation. A bank can be permitted to charge a fee and still decide to reverse it. A long account history, a first occurrence, a recent retirement, a death in the family, a system misunderstanding, or a product mismatch may support a courtesy request. Do not demand that an employee break policy. Ask for a review, ask whether a supervisor has additional authority, and document the date, time, and explanation. The same principle applies to ATM charges. The machine may disclose one fee before you complete the withdrawal, but your own institution may impose another fee. A retiree who takes out $40 can effectively pay $6 for access to $40. That is a 15% cost for a few minutes of convenience, even though it is not described as interest. 4 withdrawals can cost $24. Over 12 months, that is $288. Add a $5 monthly account fee and the annual total reaches $348. People watching right now may have enough money to avoid every one of those charges, but they are still paying because nobody showed them the pattern. The practical solution is not to carry unsafe amounts of cash. It is to identify the bank's network, request cash back at a store when appropriate, use an institution that reimburses ATM fees under clear terms, or plan fewer withdrawals. But read the limits. Some accounts reimburse only domestic fees, only up to a monthly dollar amount, or only when another condition is met. Again, this is not automatic. You have to know what the account promises and what it does not. Then there are wire fees. A domestic wire can cost tens of dollars. An international wire can cost more, and intermediary or receiving institutions may also deduct charges. A person wiring inheritance proceeds, paying for a property closing, helping a child, or moving retirement money can focus so much on the large amount that a $25 or $45 fee appears unimportant. But the fee is only one risk. A wire is often difficult to reverse after it is sent. The real protection is verification. Call the recipient using a trusted number. Confirm routing information independently. Be suspicious of last-minute changes to wiring instructions. A fee may be irritating. A fraudulent wire can erase decades of savings. There is another charge retirees miss because it does not contain the word fee. It is lost interest. Suppose a couple keeps $25,000 in a checking account to feel safe and to avoid a $15 monthly maintenance fee. If that checking account pays almost nothing while an insured savings product pays meaningfully more, the couple may be sacrificing hundreds of dollars a year to avoid $180 in stated charges. The exact rates change, and the best account depends on access needs, withdrawal rules, insurance coverage, and personal circumstances. But the principle does not change. A fee can be explicit, or it can be the return you gave up because the account structure was never reviewed. Inflation adds pressure to every mistake. When groceries, insurance, property taxes, utilities, and medical costs rise, the buffer that once protected an account becomes too small. A retiree who kept a $300 cushion 5 years ago may still keep $300 today, even though monthly bills are hundreds of dollars higher. The account feels organized because the routine has not changed, but the protection has weakened. Review the buffer in dollars at least once a year. Inflation does not create an overdraft fee directly. It silently removes the distance between your balance and the fee. The third warning is the automatic payment that you thought you canceled. Under federal electronic transfer rules, consumers can stop certain pre-authorized electronic debits by notifying the financial institution at least 3 business days before the scheduled transfer, though the institution may require written confirmation after an oral request. That right is valuable, but people confuse stopping a bank debit with canceling the underlying contract. Blocking the withdrawal does not necessarily eliminate what you owe to the gym, insurer, subscription company, lender, or service provider. You may need to cancel with both sides and preserve proof. Consider Frank, a 71-year-old widower in Michigan. His wife handled the household subscriptions. After she died, he found recurring charges for a streaming package, identity monitoring service, magazine, roadside plan, cloud storage, charitable donation, and 2 insurance products. None was individually large. Together, they exceeded $190 a month. Frank canceled several by phone but did not record confirmation numbers. 2 charges continued. He called the bank and requested a stop payment, then assumed the matter was finished. One merchant changed the description slightly and attempted another debit. Another sent the account to collections because the contract had not been canceled correctly. A careful cancellation record should include the merchant name, date, amount, contact method, confirmation number, effective cancellation date, and whether the bank received a stop payment instruction. Review the next 2 statements. Keep emails and letters. If a debit continues, dispute it promptly under the applicable rules. Do not assume that deleting an app, replacing a debit card, or closing an online profile automatically ends an authorization. If this information is useful to you so far, leave a like. That simple action helps more retirees see explanations that banks and account agreements rarely make easy to understand. Now, we can move to the hidden fee that does not appear until after a person tries to protect himself: the stop payment fee. Some banks charge a fee to stop a check or pre-authorized payment. The customer may pay $30 or more to prevent a $20 debit. In some cases, that still makes sense, especially when the larger risk is repeated unauthorized withdrawals. But the customer should ask how long the stop order remains effective, whether it covers one item or a series, whether written confirmation is required, and whether the merchant can submit a differently coded transaction. The next layer is returned item behavior. Even when a bank declines or returns a payment, the merchant may impose its own fee. A rent payment, insurance premium, utility payment, or loan draft can create consequences outside the bank. Insurance coverage could be endangered if premiums are not corrected. A loan payment may become late. A utility may require a different payment method. The bank fee is not the entire cost. This is why I tell retirees to separate essential payments from casual spending. One practical structure is to use a dedicated bill-paying account funded with a measured buffer while keeping everyday debit card activity in another low-fee account. That does not fit everyone. It can create complexity, transfer delays, and additional accounts to monitor. But for someone who repeatedly loses track of pending transactions, separation can make the invisible visible. The mortgage or rent, insurance, Medicare-related payments, utilities, and taxes no longer compete directly with restaurant holds, gasoline authorizations, and online purchases. And here is the question I promised to answer later. Why can a debit card purchase be approved when there is not enough money to cover everything else? Because approval is not a promise that every other transaction has been reserved in the order you remember. Merchants, networks, and banks communicate through authorization and settlement processes. Some transactions are authorized for one amount and settle for another. Some recurring payments arrive without the same real-time interaction. Checks can clear at different times. Deposits may be subject to holds. The system is processing instructions, not reading your mental budget. That is why I checked my balance is necessary, but not sufficient. You must know what has not appeared yet. The best low-technology method is still powerful. Maintain a written or digital register that includes checks, scheduled ACH payments, debit authorizations, and deposits not yet available. Subtract pending obligations yourself. The bank app tells you what the bank currently sees. Your register should include what the bank has not seen yet. The system's first invisible mechanism is timing. Its second is classification. A payment can be classified as a one-time debit, recurring debit, ACH, check, wire, card purchase, cash withdrawal, transfer, or fee. Different rules and account terms can apply. Its third mechanism is sequencing. One event changes the balance available for the next. The retiree sees separate purchases. The bank system sees a queue. The most expensive surprise comes when those three mechanisms meet a fixed retirement income. That is what we will examine next, because once a fee affects an essential payment, the loss no longer stays inside the checking account. The fourth warning begins when money leaves the account without permission. Retirees often believe fraud protection works the same way for debit cards and credit cards. It does not. A credit card transaction uses the issuer's credit line while the dispute is examined. A debit transaction removes money from your deposit account. Even when the consumer ultimately receives the money back, the temporary loss can interfere with rent, medicine, insurance, food, and automatic payments. Federal rules limit liability for unauthorized electronic fund transfers under specific conditions, but the amount can depend on how quickly the loss is reported and whether the card or access device was lost or stolen. If a debit card is lost and the institution is notified within 2 business days after the consumer learns of the loss, potential liability is generally limited to the lesser of $50 or the unauthorized transfers. Waiting longer can raise potential liability to as much as $500 in certain circumstances. If an unauthorized transfer appears on a statement without the card or PIN being lost, the consumer should still notify the institution immediately and, at the latest, within the applicable 60-day statement period. Delay beyond that can expose later transactions to much greater risk if the institution can show that timely notice would have prevented them. I am giving you those numbers because vague advice is not enough. Call the bank soon is vague. 2 business days and 60 days are concrete. The exact facts matter, and account agreements may provide more protection than the federal minimum, but never assume the most generous policy will rescue a missed deadline. Nobody is going to tell you about this after the deadline has already passed. Once notified, the institution generally must investigate promptly. In many ordinary cases, it has 10 business days to determine whether an error occurred. If it needs more time, provisional credit rules may apply while the investigation continues, subject to conditions and exceptions. The institution can ask for written confirmation after a telephone report. If the customer does not provide requested written confirmation on time, provisional credit may not be required. This is why every fraud call should be followed by a written record. Imagine Maria, 74, living in Texas. She notices 3 debit card charges totaling $486. She calls the number on the back of the card. The representative closes the card and opens a claim. Maria believes the claim is complete. A letter arrives asking for a signed statement within 10 business days, but she assumes it is a duplicate and sets it aside. Her utility draft arrives before provisional credit is issued. The account becomes negative, and 2 legitimate payments fail. Maria's original loss was fraud. Her secondary losses came from process. The protective response has several parts, but it can still be simple. Report the transaction. Record the claim number. Ask whether the account number itself is compromised or only the card. Ask whether recurring legitimate payments will transfer to the replacement card. Ask whether provisional credit will be issued and when. Ask what written documents are required. Review every transaction after the first unauthorized charge, because criminals often test an account with a small amount before trying a larger one. Then, protect the rest of the household. Change online banking credentials from a secure device. Review linked external accounts. Check whether a new payee, phone number, email address, or transfer destination was added. Freeze or monitor credit reports when identity theft is suspected. Contact the Social Security Administration through an official channel if benefit information may be compromised. Contact Medicare through an official channel if someone is using the Medicare number. Never call a number supplied in an unexpected text claiming that your benefits are frozen. The emotional burden here is severe. A retiree opens an app at 6 in the morning and sees the account nearly empty. The heart races, the hands shake. The first thought is that everything is gone. The second is embarrassment. The third is fear that the bank will not believe the story. That emotional state is exactly when people make more mistakes. They click sponsored search results, call fraudulent numbers, share one-time security codes, or move money to a so-called safe account suggested by a criminal. No legitimate bank employee, government agent, or technology company should instruct you to transfer your savings to a stranger's safe account to protect it. No legitimate investigator needs the one-time code sent to your phone so that he can reverse fraud. That code may be the final key needed to take control. The system's security message often says not to share it. Read that warning literally. There is also a quieter form of unauthorized loss, account takeover, followed by person-to-person payments. Some payment systems move money quickly. Fraudsters exploit urgency, impersonate relatives, banks, government agencies, utilities, and technical support staff. The transfer may be authorized by the victim under false pretenses, which can create a more difficult dispute than a transaction the victim never approved at all. The bank may view the payment as authorized because the customer pressed send. The customer views it as theft because the story was false. Those two descriptions can lead to different legal and contractual questions. The best defense is a pause that criminals hate. Hang up. Call the person or institution using a number you already trust. Do not use the number in the message. Ask a family member. Verify the request in a second channel. A real emergency can survive 5 minutes of verification. A scam depends on preventing it. Now tell me in the comments, have you ever found a bank fee or unauthorized charge only because you reviewed your statement, or are you hearing about these deadlines for the first time? The fifth warning is that your checking account history can follow you even when it does not appear on the traditional credit report you usually think about. Specialty consumer reporting companies, including check systems and early warning services, collect information related to deposit accounts. Banks and credit unions may use these reports when deciding whether to open an account, what type of account to offer, or how to evaluate risk. An involuntary closure caused by an unpaid negative balance may be reported. Suspected fraudulent activity may also become part of the record. This changes everything for a retiree who believes closing an overdrawn account ends the problem. Suppose James has a checking account that is negative by $84 after fees and returned payments. He is angry, stops using the account, and opens another one. The first institution eventually closes the account with an unpaid balance. Months later, James tries to open an account near his new home and is denied. He says, "My credit score is fine." The bank says the decision involved a checking account report. Credit score and deposit account screening are related parts of financial life, but they are not the same file. A person can have a respectable FICO score and still encounter difficulty opening a checking account because of negative deposit history. Most people never realize this. They think only loans create a financial reputation. Deposit accounts can create one too. By law, consumers generally have the right to request a free copy of their checking account consumer report every 12 months, and they can also be entitled to a free report after an adverse action, such as a denial based on that report. If information is inaccurate, the consumer can dispute it with the reporting company and with the financial institution that supplied it. This is not automatic. You have to request the report. You have to identify the error. You have to submit the dispute. You have to keep copies. This helps both lower-income retirees and comfortable middle-class retirees because account screening is not a poverty issue. It is a data issue. A wealthy customer can be misidentified. A joint account can be mishandled after a death. A fraud event can be coded in a way the customer does not understand. A negative balance can remain after the customer believed an account was closed. The remedy begins with seeing the data. When closing an account, do not simply withdraw the visible balance and walk away. Stop using the debit card. Redirect Social Security, pension, annuity, tax refunds, and other direct deposits. Move automatic payments. Wait for outstanding checks and card transactions. Ask whether any pending fees remain. Obtain written confirmation of closure. Review the final statement. If the account is joint, confirm who has authority and whether both owners must act. If the account belongs to a deceased person, follow the bank's estate procedures rather than improvising. A premature closure can create a chain reaction. Social Security may send a payment to the old routing and account number. An insurer may attempt a debit. A tax refund may be rejected. A check may be presented. The bank may reopen an account under its agreement to process an item, or it may return the item. Policies differ. The customer may then face fees or delays at the worst possible time. The quiet danger is greatest after major life events. Retirement, disability, divorce, death of a spouse, relocation, sale of a home, inheritance, and entry into assisted living all cause money patterns to change. Automated systems notice change. A large deposit arrives. Several transfers follow. New devices access the account. Addresses and phone numbers change. A trusted child begins helping. Checks are written to unfamiliar payees. None of this proves wrongdoing, but it can trigger verification, holds, fraud reviews, or requests for documentation. Banks have obligations under the Bank Secrecy Act and anti-money laundering rules. Financial institutions file currency transaction reports for cash transactions exceeding $10,000 in a day when the reporting rules apply, and they report suspicious activity that may indicate money laundering, tax evasion, or other crime. Do not misunderstand this. A legitimate $15,000 cash deposit is not illegal merely because it is reported. Selling a car, receiving cash from a business, or consolidating money can be lawful. The report is a compliance requirement, not a conviction. The dangerous mistake is trying to avoid reporting by breaking one legitimate cash transaction into smaller transactions. That behavior, often called structuring, can itself create serious legal risk. A person who says, "I'll deposit $9,000 today and $6,000 next week so nobody asks questions," may turn a lawful source of money into suspicious behavior. Never arrange transactions to evade a reporting requirement. Deposit legitimate funds honestly. Keep records showing the source and answer reasonable bank questions truthfully. Banks also monitor electronic patterns. That does not mean an employee is reading every grocery purchase. Modern institutions use automated systems, rules, and risk models to identify unusual activity. Artificial intelligence and machine learning can support fraud detection, customer authentication, credit decisions, and transaction monitoring, but the exact systems differ. The benefit is speed. The risk is false positives and impersonal decisions. A 79-year-old customer who has never sent a wire suddenly attempts to send $85,000 to a new recipient after receiving instructions by email. A protective hold or additional verification may feel inconvenient, but it may prevent catastrophe. A 79-year-old customer sending the same amount to a verified title company for a home closing may still face the same questions. The algorithm sees novelty and amount before it understands purpose. The purpose has to be documented. The feeling of being watched financially can become overwhelming. Retirees already receive messages about Social Security, Medicare, taxes, required minimum distributions, property assessments, insurance renewals, and fraud. Then, a bank asks why they are moving their own money. It can feel like every institution is waiting for a mistake. I understand that feeling. But protection comes from distinguishing lawful monitoring from imagined persecution. The system is not one mind. It is a collection of agencies, institutions, contracts, reports, databases, and automated controls that sometimes communicate and sometimes do not. The IRS can receive information returns. Social Security can use tax information in specific benefit and Medicare-related processes. Banks can report under financial crime rules. Credit bureaus and specialty reporting companies can maintain consumer files. None of that means a single person is watching your life in real time. The danger is not a secret individual. The danger is an invisible mechanism that can produce fees, delays, denials, or questions when data moves between systems faster than explanations do. This is the emotional pause every retiree needs. You worked for 30 or 40 years. You paid taxes. You raised a family. You saved what you could. You may have survived layoffs, inflation, medical bills, recessions, and interest rate shocks. Then one morning a computer says a transaction is suspicious, an account is negative, a payment is late, or a fee is valid. It feels as though your history has been erased and only the last 24 hours matter. Do not let that moment convince you that you are powerless. Documentation is power. Deadlines are power. Knowing the name of the rule is power. Asking for the fee schedule is power. Requesting the checking account report is power. Escalating a dispute in writing is power. Filing a complaint with the appropriate regulator when ordinary resolution fails is power. Consulting a qualified attorney, accountant, financial planner, or benefits specialist is power. This content is educational and does not replace personalized financial, legal, tax, accounting, or benefits advice. Your account agreement, state law, transaction type, filing status, health coverage, and family circumstances can change the correct action. But education gives you the questions that professional advice should answer. The next warning connects bank fees to Social Security and Medicare, and this is where a small banking decision can quietly change the amount a retiree has available every month. The bank does not need to raise a fee for the household to lose money. Sometimes the loss begins when a withdrawal changes taxable income changes a Medicare calculation, and the retiree notices only the smaller net benefit years later. The sixth warning is the fee hiding inside retirement money. People examine a checking account statement for a $12 charge but ignore the percentage deducted inside a 401k, IRA, annuity, managed account, or mutual fund. The Department of Labor has long warned that fees and expenses can substantially reduce retirement growth. In one official illustration, a worker with $25,000 invested for 35 years at a 7% return would reach about $227,000 if fees reduced returns by 0.5%, but only about $163,000 if fees reduced returns by 1.5%. A 1 percentage point difference reduced the ending balance by roughly 28%. A retiree may say, "But I am already retired, so 35 years does not apply to me." The time period may be different, but the mechanism remains. A 1% annual advisory or account charge on $400,000 is $4,000 in the first year, before considering other expenses. An expense ratio of 0.80% inside an investment costs about $3,200 a year, on the same balance if the balance stays near that level. A separate platform, custodial, transaction, annuity, rider, surrender, transfer, or termination charge may apply. Some costs are reasonable for valuable services. The danger is paying costs you do not understand for services you do not use. Ask for the total cost in dollars, not only percentages. Ask what the account paid last year in advisory fees, fund expenses, trading costs, administrative charges, insurance costs, and account fees. Ask whether cash in the account earns interest and who benefits from the spread. Ask whether moving the account creates a surrender charge, tax consequence, transfer fee, loss of guarantee, or loss of creditor protection. Never move retirement money solely because someone says another account has no fee. The cost can be relocated rather than eliminated. Retirement withdrawals create another invisible chain. Traditional 401k and IRA distributions are generally taxable unless a specific exception or basis applies. Roth rules are different and depend on requirements such as account history and the nature of the distribution. A large withdrawal can increase adjusted gross income. That can increase the taxable portion of Social Security benefits, affect deductions or credits, and raise Medicare income-related premiums 2 years later. A Roth IRA can reduce future taxable income when its rules are satisfied, but the word Roth does not erase every condition. Contributions, conversions, earnings, inherited Roth accounts, and early distributions can be treated differently. Each conversion can carry its own 5-year period for certain early distribution rules. A retiree who moves money from a traditional IRA to a Roth creates taxable income in the conversion year, even though the money remains inside retirement accounts. The bank or brokerage can execute the conversion. It does not decide whether the amount pushes the household into a higher tax bracket or Medicare tier. That is a planning decision, not a transaction processing decision. For 2026, the standard Medicare Part B premium is $202.90 per month. Medicare generally uses modified adjusted gross income from the tax return 2 years earlier to determine the income-related monthly adjustment amount. For 2026, an individual with 2024 income above $109,000 or a married couple filing jointly with income above $218,000 can enter the first higher Part B tier. At the highest published tier, the Part B premium reaches $689.90 per month, and Part D can carry a separate income-related adjustment. Picture a married retired couple with comfortable savings but ordinary monthly cash flow. They withdraw an extra $90,000 from a traditional IRA in 2024 to pay cash for a vehicle, help a child, and remodel a kitchen. The bank processes the transfer without a special warning about Medicare. The brokerage issues Form 1099-R. The IRS receives the information. In 2026, Social Security uses the relevant tax data for the Medicare calculation. The couple opens a notice and sees higher premiums. The original withdrawal did not include a line labeled Future Medicare Cost, but the cost was built into the tax interaction. This is not a reason to fear every withdrawal. It is a reason to coordinate withdrawals before December 31st, especially when income is near a threshold. Sometimes spreading a withdrawal across tax years, using taxable cash, realizing gains strategically, making qualified charitable distributions when eligible, or choosing another funding source may help. Sometimes the withdrawal is still the right decision even after the higher premium. The answer depends on numbers. Life-changing events can support an appeal of an income-related Medicare adjustment in certain circumstances. Retirement or work stoppage, loss of income-producing property, divorce, death of a spouse, and other recognized events may matter. Social Security uses Form SSA 44 for certain requests involving a life-changing event and reduced income. Most people think they don't qualify because the notice looks final. It may not be final. This is not automatic. You have to claim it, support it, and use the correct process. Required minimum distributions create another deadline. Many owners of traditional retirement accounts must begin RMDs at age 73 under current rules, though the exact starting year depends on birth date and account type. Failing to take the required amount can trigger an excise tax of 25% of the shortfall, potentially reduced to 10% when corrected within the statutory correction window. Form 5329 may be required, and the IRS can waive the tax for reasonable error when reasonable corrective steps are taken and the proper explanation is submitted. The bank or custodian may calculate an estimated RMD, but responsibility does not always disappear because a statement contains a number. Multiple IRAs can create aggregation questions. Employer plans can follow different aggregation rules. An inherited IRA can follow separate distribution requirements. A person can take the right total amount from the wrong type of account and still have a problem. Nobody is going to tell you about this in a way tailored to your complete household unless you ask someone to review every account together. If you want to continue receiving information like this, consider subscribing to the channel and turning on notifications so you do not miss the next videos. The 7th warning appears after death when families discover that account ownership, beneficiary designations, and insurance categories matter more than the balance printed on the final statement. FDIC insurance generally covers at least $250,000 per depositor per insured bank for each ownership category. That means $300,000 in 2 accounts at the same bank under the same ownership category is not automatically insured as 2 separate $250,000 amounts. It may be aggregated. Different ownership categories can change the calculation, and trust account rules require careful attention. A retiree may spread money across brand names without realizing that 2 brands operate under the same insured bank. Another may keep $600,000 from a home sale temporarily in one single owner account. Another may add a child as joint owner for convenience without understanding the legal, tax, creditor, and inheritance consequences. Another may name one beneficiary on an IRA, another in a will, and none on a checking account. At death, the family assumes the will controls everything. Beneficiary and ownership rules may direct assets differently. The federal estate tax basic exclusion amount for a person dying in 2026 is $15 million, so most American families will not owe federal estate tax. But that does not mean inheritance planning is unnecessary. Some states impose estate or inheritance taxes at much lower levels. Income tax can apply to inherited retirement accounts. Probate costs, legal expenses, property transfer costs, appraisal fees, account closing fees, and investment expenses can still reduce the inheritance. A family can owe no federal estate tax and still lose substantial money through poor coordination. Banks may freeze an individually owned account after learning of the owner's death, subject to applicable law and account terms. Automatic payments can continue or fail. A surviving spouse may discover that the household bill account was only in the deceased spouse's name. A power of attorney usually ends at death. The person who had authority yesterday may have none today. The family then needs death certificates, beneficiary documents, trust papers, letters testamentary, or small estate procedures. The protective work must happen before the crisis. Confirm account titles. Confirm payable on death or transfer on death designations where appropriate. Confirm retirement beneficiaries. Review contingent beneficiaries. Store a secure account inventory. Make sure a trusted person knows where legal documents are located without giving unnecessary access during your lifetime. Review FDIC coverage using ownership categories, not assumptions. Coordinate the will, trust, beneficiary forms, and account titles with a qualified estate attorney. Now we reach the most important revelation in this entire warning. The most dangerous hidden bank fee is not a single fee. It is the chain reaction created when one fee changes the next transaction, the next report, the next deadline, and the next decision. Watch the gears turn. A retiree keeps only $80 above scheduled bills. A merchant hold reduces the available balance. A recurring debit posts. The bank charges an overdraft fee. The next insurance payment is returned. The merchant adds a returned payment fee. The account remains negative. A Social Security deposit arrives and is immediately reduced by the negative balance. The retiree uses a credit card for groceries. The card balance rises. Interest accrues. A late notice creates fear. The retiree withdraws an extra $8,000 from a traditional IRA. The distribution is taxable and appears on Form 1099-R. Additional income increases the taxable portion of Social Security. At a higher income level, it can contribute to a future Medicare adjustment. The retiree sees only the first $35 fee, but the true cost spreads across banking, credit, tax, and health insurance systems. Then the second gear turns. The retiree becomes angry and abandons the account without bringing it to zero. The bank closes it with an unpaid balance. A specialty checking account report records the involuntary closure. The retiree later struggles to open a new account. A benefit payment is delayed because direct deposit instructions were changed too late. The family says the system punished someone over $35. In reality, the system processed a series of separate events, each governed by a different rule, and no institution was responsible for explaining the whole chain. This is the silent machinery. The bank's posting engine does not see Medicare. Social Security does not see the pending restaurant authorization. The IRS does not see why the IRA withdrawal was emotionally necessary. The credit card issuer does not see the returned insurance payment. Check Systems does not see 40 years of responsible work when it receives a coded account closure. Every system acts on its own information. The consumer is the only person standing in the middle of all of them. That is why retirement protection requires a monthly financial control routine. Not obsession, not checking the app every 10 minutes. A calm routine. Open every statement. Reconcile the real balance with outstanding payments. Identify every fee. Confirm direct deposits. Review automatic debits. Check interest rates. Review credit card due dates. Keep enough operating cash for timing differences. Examine retirement account costs at least annually. Review beneficiaries after major life events. Save notices from Social Security, Medicare, the IRS, banks, and custodians. Respond before deadlines. When a fee appears, do not ask only, "Can you remove it?" Ask what caused it, whether it can happen again, which account setting controls it, whether a lower cost product exists, and what written disclosure applies. A refund without a system change is temporary relief. The same fee can return next month. When a notice appears, do not let fear decide the first move. Verify the sender through an official channel. Read the deadline. Identify the account and transaction. Gather the statement, receipt, confirmation number, tax form, or benefit notice. Write down what happened in chronological order. A clear timeline can turn a confusing dispute into an understandable case. When a representative says no, remain calm. Ask whether the decision is based on policy, account terms, federal rule, state law, or missing documentation. Ask for the reason in writing. Ask whether an appeal, supervisor review, or complaint process exists. Most people think they don't qualify for help because the first person said no. Sometimes the first answer is correct. Sometimes it is incomplete. You have to claim the review that the process allows. Do not threaten employees. Do not invent hardship. Do not hide transactions. Do not split cash deposits to avoid reporting. Do not transfer money because a caller creates panic. Do not close an account until every deposit and payment has moved. Do not take a large retirement withdrawal without understanding tax and Medicare effects. Do not assume federal deposit insurance is calculated by account nickname. Do not assume the will overrides a beneficiary form. Do not assume an app balance includes everything you promised to pay. The goal is not to distrust every bank. Banks provide essential services, and many institutions have reduced or eliminated certain fees. The goal is to understand incentives and mechanics. A bank can be safe and still offer an expensive account. A representative can be honest and still see only one part of the system. A disclosure can be legally accurate and still be difficult for an ordinary customer to understand. Protection begins when you stop treating the bank balance as the complete picture. You still have time to act. Review the last 3 months of statements. Add every maintenance charge, overdraft, ATM fee, transfer fee, paper fee, stop payment fee, returned item charge, investment account fee, and interest charge connected to a banking mistake. Then calculate the annual cost. A $12 monthly fee is $144 a year. 2 $35 overdrafts per quarter are $280 a year. 4 6 ATM visits per month are $288 a year. Together, that is $712 before lost interest, merchant charges, or credit card costs. $712 can pay for prescriptions, groceries, utilities, insurance, or travel to see family. Over 5 years, without considering investment returns, it is $3,560. The number is not dramatic because I exaggerated it. It is dramatic because ordinary fees repeat. Call the institution using the official number on the card or statement. Ask for the current fee schedule. Ask whether a lower cost account matches your deposit pattern. Ask to remove overdraft coverage for ATM and one-time debit transactions if that is your choice. And ask separately how checks and recurring payments are handled. Set low balance alerts with enough room to act. Keep a manual record of outstanding payments. Request courtesy reversals when appropriate. Compare insured alternatives. Review account ownership and beneficiaries. Then look beyond the bank. Check the costs inside the 401k, IRA, annuity, brokerage, and managed account. Review RMD obligations. Estimate the tax effect before a large withdrawal. Check whether a life-changing event may support a Medicare IRMA appeal. Request your checking account consumer report if you have been denied an account or suspect inaccurate information. These rights and opportunities are not automatic. You worked too long to let complexity take what carelessness did not. The system favors people who understand timing, classification, documentation, and deadlines. That does not mean you need to become a banker, lawyer, or accountant. It means you need to know when a simple-looking transaction has consequences outside the screen. Share this video with a spouse, sibling, veteran, neighbor, or friend who lives on retirement income. Do not send it to frighten them. Send it so they know where to look before a small charge becomes a larger loss. And if you think this warning is important, watch the next video appearing on the screen now. In it, I explain another financial situation that can directly affect the money of millions of retirees and that almost nobody is watching closely enough. The purpose is not fear. The purpose is awareness, intelligent action, and protection of what took a lifetime to build.